If you're thinking about buying a home and don't have the ability to pay cash, it's important to familiarize yourself with the mortgage approval process. In this video, I'm going to walk you through the process so there are no surprises once you take that step. So let's start off with the pre-approval process. So pre-approval is just as the name sounds. It's the process of getting qualified for a mortgage prior to going out and finding a home, which is the pre in pre-approval. So this would typically entail you having a conversation with a loan originator, discussing what your home buying goals are, your income, your employment, any money you've saved up to use toward the purchase, talk about your credit profile. And of course, if you decide to move forward and actually get pre-approved, that lender would collect documents to support the information that you discussed regarding your income, employment, assets, and pull your credit report so they can see exactly where you stand when it comes to your monthly liabilities and, of course, your credit scores. They're going to take all of this information and they're going to use that to determine what you qualify for. You might qualify for less than you were hoping for, or you might actually qualify for more than you were hoping for. But the pre-approval process is going to help you determine exactly that. This way, once you decide to go out and start looking at homes, you know what you're sort of be looking at when it comes to the housing costs, what the monthly payment would be, and exactly what you're getting into for cash to close. This will help you determine the price range that you might want to stay in with your home search, because that doesn't always align with what you're qualified for. What you want to pay and what you're qualified to pay aren't always the same thing. So pre-approval is going to help you determine what you qualify for and where you're comfortable when it comes to your monthly payments and price range for a home that you're going to buy. Now, this process should be quick. It's really a matter of how fast the loan originator that you're speaking with moves and how quickly you're able to provide the documents necessary for that individual to complete the pre-approval process for you. But in reality, it should only take 1 to 2 days, assuming you have the documentation readily available to provide to the loan officer. That's going to be your pay stubs, your W-2s, bank statements, potentially tax returns if you're self-employed. But if you provide these in a timely manner, which I would consider that to be within a day of the initial conversation with the loan originator or loan officer, then you should be able to have your pre-approval that same day or the following day. Now, once you're officially pre-approved, that pre-approval is good for 120 days. And I look at it like this. You have about 90 days to shop for and find a home. And then you have 30 days to close on that home, which is your 120 days. The reason it's good for 120 days is because that's the same amount of time that your credit report is good for. So it's not that you can't go ahead and get your pre-approval extended beyond 120 days if you were to get to day 121. What it means is that when you got to day 120, well, now you need to have a new credit report pulled and you have to provide updated documents for anything that's expired, such as pay stubs, bank statements, or really anything that has a 30-day timestamp on it, right? Which is primarily going to be your pay stubs and your bank statements. But worst case, you have a new credit report pulled. Best case, you're able to find something within that 120-day window and close on it within that same window. Now, you go under a contract for a property. That's when you officially move into the loan approval process. Now you're beyond pre-approval because you've done that to actually go out and look for homes. Once you are under contract on a specific property, your loan needs to go through the mortgage approval process. And what that means is that you provide any updated information or documents for anything that's now outdated, and the loan is submitted into underwriting. The underwriter is the person who makes the decision on your loan as to whether or not you can close on the property you've selected. Now, there are some lenders who will actually do that underwriting process up front for you before you go under contract. So on top of being pre-approved, you can actually have an upfront underwrite done on you and your scenario. So this way, you're as good as approved for that loan once you find the right property. So assuming the property checks out and you've gone through the upfront underwrite and upfront approval process, well, then you can close even faster and you have nothing to worry about when it comes to qualification for the property. So it gives you a little bit more peace of mind. It just makes your letter that you get from the lender a little bit stronger when presenting offers on properties. So you can ask for that upfront underwrite. And if the lender doesn't offer that, then you might want to find a lender who actually does. Because as much as it doesn't necessarily matter in today's market, as you have more and more people coming into the market making offers on the same properties, and this becomes a multiple offer situation again, or a market where there's multiple offer situations again, then you're going to need to have the strongest possible offer. So having that upfront underwrite done is going to make it as strong as you possibly can without you being a cash buyer for the property. But let's say you didn't do that. You went under contract. Now you're in the mortgage approval process. Well, the underwriter is going to go ahead and review everything you've provided, and they're going to mark off whether or not you meet the underwriting guidelines. And they're going to request anything they feel is necessary from you before they can issue a final approval on that loan. So they're going to go ahead and they're going to request maybe letters of explanation pertaining to your income or things that might be on your credit or possibly large deposits that they saw in your bank account, right? So those types of conditions are going to be requested from an underwriter. You get a conditional loan approval from that underwriter and your lender, and now you provide those conditions, and if you meet them, well, now your loan will go back into underwriting to get the final approval on the loan. Now, that process is usually quick. You're given a period of time within your contract where that has to take place. So that period of time per the contract here in Florida is set at 30 days automatically. But to be competitive in any market, your realtor is going to want to shorten that period of time that you have to provide a loan approval. This is your finance contingency. So the shorter you can make that period, the more attractive your offer will be to a seller. So as I was mentioning, as we get into a multiple offer market again, you're going to need to make these offers as attractive as possible. By doing an upfront underwrite, you're able to shorten that period of time that you're listing for the loan approval from 30 days. It can be down to 1 or 2 days, right? Even 10 days is going to be more attractive than submitting an offer with a 30-day loan approval window, because that means that any time within that loan approval period, you can actually cancel the transaction for getting denied for the mortgage and get your deposit back from the seller. Because when you go under contract on a property, you are going to give a deposit that's held by the title company, which is only at risk once you've gone past these contingencies in your contract, one of which is your loan approval period. So as I said, the shorter you can make that window, the more attractive it will be to a seller, and the easier it'll be for you to get properties under contract. But it's extremely, extremely important that you went through that pre-approval process and potentially that upfront underwrite to get qualified for a mortgage in order to shorten these timelines and make your offers more attractive, as I said. Now, back to the loan approval period, once you've gone under contract on a property, this timeline from the time that you actually go under contract, provide updated documents to your loan originator or loan officer, and get that into underwriting could vary from lender to lender. It's really based on what their underwriting turn times are at any given time, and that's usually based on their workload. So that can range anywhere from 24 hours up to a week in some cases, depending on how many files that underwriter needs to review. So you want to keep these things in mind when you're creating your timeline when it comes to the loan approval period with your realtor. Make sure you're working with a lender who can meet your timelines. Now, you might be saying to yourself, I don't even know if I'm ready to purchase a home or if I'm ready to get pre-approved. I don't know if I want to have my credit pulled and go through that process. Most lenders nowadays can do a soft credit check for you, which can be used to actually get you pre-approved for the property or for a property. So you don't have to have a hard credit inquiry done, but it's a good idea to speak with the lender and have them at least do that soft check so they can guide you properly on where you stand when it comes to the approval. Because if you're basing your thoughts of getting qualified on maybe what you see on Credit Karma or your free credit reporting websites, such as your credit card site, then you're going to be in for a rude awakening once the lender pulls your true credit report for the purpose of getting qualified for a mortgage. And this is because the scoring model used when applying for a mortgage is different than what you're going to see on the websites for your credit card or Credit Karma, as I said, because those scores tend to be higher than what a lender is going to pull for a mortgage. So have the soft credit check done if you're not quite sure of a timeline or whether or not you're ready to move forward with the pre-approval. This will at least help guide you better on where you stand when it comes to the credit scores and what your next steps should be. Now, if you are okay having a hard credit inquiry to complete your pre-approval, that's going to be good for 120 days, as I said. But what you might not know is that you actually have a 45-day window, which is your right to shop window, where any subsequent mortgage credit inquiries that are done within that window by other lenders for a mortgage will not negatively impact your credit scores. So that's your time to shop. You have 45 days from the time the initial credit pull is closed on by a mortgage lender without negatively impacting your scores. Now, when you're talking to your lender, make sure to ask all of your important questions up front. This way, there's no surprises as you move through the process. These are things such as, what type of fees do you charge? Will the mortgage that I'm getting from you have a prepayment penalty? Meaning if I pay it off early, will I be penalized for doing so? And a multitude of others. You want to make sure that you understand exactly what you're getting into when you're getting qualified for a mortgage. If you enjoyed this video and found the information useful, please subscribe for more videos just like this one. And I encourage you to share your experience and tips in the comments section. I reply to 100% of the messages I receive.